Hello, everyone, and welcome back to the weekly rebalance. We've got a fun episode for you today. Not going to be like our normal one here. We're going to be talking about finance movies and, how we rate them as being realistic, but also how they tie to the wealth management industry. Hence my outfit. Just got to remind people why compliance departments exist. And I think it's going to be a fun one.
I could not stop laughing when we first jumped on here and saw you in that tie.
Hey, man,
Especially when I know you're at home.
you gotta look sharp. You gotta look sharp.
I hope the bottoms match, Nick, and you're not sitting there in boxers.
Oh, I can stand up for you. I've got my belt on and everything. We're all ready to go. Only thing
I
I'm
hope
missing is suspenders. I don't have suspenders.
that's funny. I hope you wore that all day too.
I did not. I did not.
Dang it.
Just for this. Just for this. Only
Funny.
for the weekly rebalance listeners.
I gotcha. Nice. Well, I know we're going to talk about a little bit different topic in our research, but should we do a market update first?
Yeah, let's do it.
What's
Let's
it
do it.
looking like out there you want to focus on equities first, Nick? It's been a couple of uh couple of wild rides the last couple of weeks.
Yeah, it certainly has been. I mean, last week being no exception to the rule there. S&P down, kind of breaking a streak where we'd had some positive weeks here. S&P 500 ended up down 1.44% last week, and then the Nasdaq down 2.1%. And again, I think we're going to tie this into some other items in fixed income, but we've got rising yields and continued inflation concerns that are really weighing down on things like growth stocks. Some of the underlying moves that we saw underneath the surface were, defensive sectors really outperformed last week. Healthcare up 4.32%, materials up 2.28%, and some more cyclical sectors like industrials were down. So really interesting, kind of speaks a little bit to where we're at in the cycle potentially. But interesting to watch that rotation, especially leading into this week where we've got NVIDIA earnings tomorrow. A lot of the excitement around growth stocks, particularly chip stocks, can come from those earnings calls. So seeing that going into an earnings call is really interesting. But certainly those fluctuations in yields and inflation concerns definitely weighing on the market right now.
Yeah, yeah, absolutely. Let me share my screen here really quick and we can start talking about yields because I think that's really a lot of the story here. This is the Treasury yield curve since June 30th to today. The dark green bold line is today, and this yellow dotted line is June 30th. And you can just see, especially on this long end of the curve here, we've seen a pretty significant rise in the 20-year and the 30-year yields. 30-year yields up, what is it, just over 20 basis points. 20-year yields up almost 20 basis points. So borrowing costs rising quite significantly on the long end of the curve, which is definitely caused some angst in markets, both fixed income markets and in equity markets.
Yeah, it
But
certainly has.
pretty notable bear steepening there. The short end of the curve kind of anchored where it is, and the long end of the curve rising quite a bit. So lots to digest there in fixed income and in equities, but a lot in fixed income in particular.
Definitely. I mean, I think it's really interesting too, just especially over the past weeks. The 10-year is often where equity analysts point, or most equity markets point. They don't necessarily look at the 30-year, but particularly sometimes that relationship isn't as pronounced. But over the past couple of weeks, watching the 10-year creep up and seeing some of these more rate sensitive industries feel that a little bit more has been interesting to watch that relationship play out.
Yeah, exactly. Well, and there's really, from my perspective, there's really the Friday talk we got PCE data on Thursday, I believe. So some more inflation data on Thursday, and then we're going to hear Warsh talk again on Friday. And it'll be important to watch that Treasury curve post that conversation because it really, from my perspective, goes one of four ways. but really primarily one of three different ways that what we see unfold. We're in this kind of bear steepening right now, where we've seen the short end of the curve anchored where it is, the long end rising. And the Fed, on this is my perspective, right? So I'm just sharing what I think. I guess anything could happen, right? But these are the kind of four scenarios in which I see over the next, let's say, 12 months that are most likely. One being bear steepening, which is what we've been in for the last, let's say, 2 months. The Fed is holding, the long end sells off and yields rise, and the front is just where it is. So if the Fed is kind of wishy-washy and Warsh doesn't give clear direction and we're just in this holding pattern again on Friday, then we probably stay in this regime up here at bear steepening. If the Fed hikes and the front end of the curve rises and the long end lags or stays as is, you could see kind of a bear flattening, right? That will that's certainly one option. And then there's bull steepening as well, which would be the Fed cutting. I think is probably the least likely outcome. The Fed is probably not likely to cut, and you have the front end yields drop significantly and the long end stays where it is. You'd have a much steeper yield curve there, but possible. And then the last and the least likely would be all of a sudden inflation gets under control and you have disinflationary environment where the yields just drop across the board. Pretty unlikely in my opinion. So it's really probably between this bear steepening and bear flattening, and it's really, is the Fed going to give direction or not? I guess this bull steepening is an outside case, an outside possibility as well, that they're going to cut if they're more worried about growth concerns. But I don't know, looking at what we've got here, I'm not necessarily putting out there that we have likely an inflation scare like in 2022, but I think inflation is going to be stickier than expected, and the Fed is really wrestling with that inflation issue and growth. So they're kind of stuck in a difficult spot, which is leading them to this hold pattern, but it's created this bear steepening environment where 30-year, 20-year yields are rising pretty significantly.
Yeah, certainly a difficult place to be. I mean, again, even if they were to cut rates or hold them steady, if there's a sign that maybe they should have hiked, or if the market thinks they should have hiked, it's hard to not see that 30-year, the long end of the curve, continue to shoot up. If they hike, which I know a lot of the market tools that we use to assess what the market's expecting from that isn't really pointing towards a hike at the next meeting or anything like that. But if they hike, could be interesting to see if we potentially see like the 30-year come down a little bit as we see the short end of the curve rise, as the market prices in, oh, hey, they are really serious about controlling this inflation thing with short-term interest rates. So I think we're going to get a lot of insight, hopefully, from the conversation on Friday. And a lot of different scenarios that could play out here. But
it'll be curious to see if Warsh addresses Bessent and the Treasury buybacks as well, because the last week has seen Treasury yields fall actually a decent amount. Still up significantly from the end of June, but we've seen them fall because the Treasury is supposedly announcing that they're going to buy back Treasury bonds, which would, so if you're buying back the Treasury bonds, you bid up the prices, the yields come down. It just seems like, that's basically QE without being explicitly stated that it's quantitative easing. And I don't know how that's going to, I don't know. There's a lot of dissenters or people that disagree with that approach from Bessent. I'm probably in the camp of disagreeing with them on that as well. It's just a major issue, though. It dodges the major issue, which is we have higher borrowing costs for the U.S. Treasury, for the U.S. government at the 20-year, at the 30-year, because they have a higher and higher deficit. And really, the way to solve that is not QE. It's you have to run a more balanced budget. You either have to have more revenues come in or you have to cut spending. And neither is being addressed as the major issue by doing Treasury buybacks at the 20 and 30 year. And that's it's kind of it might bring yields down, which is, great, but you can see why they're concerned about it, because the Treasury debt service is becoming a greater and greater part of GDP, and it's not going to get any better unless we solve one of those two problems, either more tax revenue coming in or cut expenditures one way or another. QE buying back treasuries, in my opinion, is not solve the crux of the issue. But I don't know what you think about that, Nick.
Yeah, I mean, I tend to agree with you. You're kind of putting a Band-Aid on the issue there. The other thing that I see with that potentially would be how it actually relates to the debt service for the US. I mean, the US, for the most part, a lot of the debt for the US is shorter term. We're not looking at 30, 20 years here. We're looking more of like a maturity closer, I think, less than the 10-year range when we did that deep dive a while back. So, potentially this is a little bit more positioning, talking about housing affordability, things of that nature, bringing down the Treasury yield curve, which would, in theory, reduce the borrowing costs for end users as that base curve comes down. Potentially more of like a posturing thing, or making it more affordable for Americans to buy homes, things like that. But yeah, it certainly does tie to U.S. debt service as well. I mean, if you buy down the rate on the long end, and if you issue more, at what point does it just wash out? But
right.
Yeah.
So they're going to have to deal with that one way or another at some point. So I don't know. We will see. But interesting stuff to follow. The big news this week being inflation data on Thursday, and then seeing what Warsh has to say on Friday.
Yep, it'll be really interesting. And like I said, I mean, I'm been trying to catch up on everything with Bessent and Warsh here going on, because there's a lot playing out here.
The breaking story.
Yeah, I mean, I know we had that come out last week, and I've read a bit about it. I've been trying to catch up. It's just, two very new and different approaches here that we're having to digest to position our fixed income models. But
yeah, certainly. Definitely the case.
Yeah.
Well, that's really my thoughts on the markets this week. Should we is there anything else you want to add to that, Nick, or should we dive into our more fun topic?
Yeah. No, I mean, the only other thing I wanted to talk about, and this ties to rates and, just a belief in the Fed being able to control inflation and just the sovereignty of the US dollar. But Bitcoin and gold have been having quite the run here recently, stemming from some of these issues that we're seeing here, and potentially some lack of faith that the US will continue being able to service the debt as things continue to compound.
Yeah. Bitcoin and Ethereum and any of those crypto assets they've been ripping. Today was the first day in quite a few that we just even had a muted day. Bitcoin, looks like, for the trading day was positive 0.23%. A mild day for the last couple of weeks.
Yeah, it's been hard to keep up, to be honest with you. It's just been moving so quick. But all of it ties back to what we're talking about here. And I mean, plowing into gold and Bitcoin doesn't necessarily mean that people think default is imminent. It's just kind of trading in that direction. I know earlier, a year ago, we were talking about the debasement trade and things like that. Seeing that spark up again has been interesting to coincide with all of these other events.
Yeah, definitely. Well, there's some relevance to our research topic of the week here as well, because we wanted to one of the things we wanted to do here was we wanted to have some fun and rank some movies, right? But trying to bring in some real world accuracy. How accurate really is it? And then what's the relevance for us today in the in our current world? Let's do it. Nick, what would you if you had to just rank your favorite
Yeah.
Wall Street finance Hollywood movies? Do you have what do you want to do? Like a top three?
I'm totally up for doing a top three. I think Big Short is at the top of the list.
Yeah.
I don't know of anyone that doesn't love that movie. And there's a lot of reasons to really like it. Big Short's probably at the top of my list. Uh, from there, I think it's a pretty steep drop off, at least in my opinion.
Yeah.
I really enjoyed Margin Call when I watched it, but like I watched it with my wife and she didn't really enjoy it. And I can't blame her. It's a pretty technical movie. So
Yeah.
I enjoy that one a lot. That's probably my number two. And then I don't know. I mean, Wolf of Wall Street is fun. Maybe that's number three. I don't
Yeah.
know. I think that's my top three. What about you?
Yeah, I have a similar. Big Short is my favorite for sure. I think it actually has like as far as its real world accuracy goes as well. It's pretty, it does a really good job of describing CDOs and all of that stuff in a very digestible format, even for
Yeah.
someone who's not in finance. So that's got to be a top one. And then probably for me, I really like Too Big to Fail. That was an interesting one for me. And probably then Wolf of Wall Street as well. That's obviously, as far as if you were just picking on entertainment, Wolf of Wall Street actually, in my opinion, has to be number one. I mean, it's an entertaining movie for sure, but there's very little, in my opinion, real world. Um, there's a lot of what is it? Martin Scorsese's the director. He takes some liberty in leaning into spectacle there over the historical accuracy and whatnot. But I mean, it's all true. It's just based on a true story. Definitely
Exactly.
applies there.
Exactly. Yeah. No, there's a lot of interesting dynamics with that. I mean, let's see here. We've got some other movies on our list here. In fact, I have a way that we can kind of rank this really quick. I actually haven't seen all of these movies. Like you were talking about Too Big to Fail. I haven't actually seen that one. And then the other one that's coming up on our list here is Boiler Room, which I don't know. Have you seen that one?
I have not seen that one either.
Yeah, I haven't seen that one either. So I'm going to take that off of our list here. But we've got really quickly, we can run through this list here and maybe chart how we see them. Basically, I've just got a graph here, realistic, or a measure of realism on the y-axis. On the x-axis, just did we like it more or less?
Yeah.
Uh, these are just placed here randomly. This is how it kind of started, but I mean, we don't have to run through this whole thing, but I think we already talked about Big Short being really, really enjoyable, pretty realistic, somewhere over
Yeah,
here.
I would agree.
Let's see here. Another one, I think you watched this one as well, Dumb Money, the one about the GameStop.
Oh yeah, that's a Netflix one. That's a
Yeah,
good one as well.
that is. I do remember having fun with that one also.
Yeah.
Uh,
It's pretty realistic as well. I mean, it's more of a documentary than it is anything else. So I'd have to put that up there in terms of realistic as well, but probably not as fun for the non-finance nerd.
yeah, yeah, for sure. Somewhere over here.
Yeah.
Uh, Margin Call. I think this is actually pretty fair. It feels pretty realistic from at least an outsider's perspective. I mean, we're not on Wall Street. We're not necessarily on a risk management desk and doing that sort of thing. But from my understanding of how those sort of things works, it seems pretty realistic. And I enjoyed it, but probably not the most enjoyable movie for your casual watcher.
Yeah.
Uh, Wolf of Wall Street, I think this is pretty fair. I think we could put that on a similar level of enjoyment of The Big Short, but much less realistic.
Yeah. Agreed.
Um, let's see here. Trading Places, that was a wild movie. We've talked about that one before. I think this is pretty fair. It's classic goofy 80s movie, unrealistic, kind of fun, kind of weird.
Yeah.
And then let's see here, Wall Street, the inspiration for my beautiful outfit here today. I actually watched that movie for the first time last night in preparation for the episode. Um, Kind of similar with Trading Places, one of those 80s movies that it's very from the era, I guess is the way I would describe it. And it's kind of enjoyable, but it's also kind of, I don't know, it's a little bit dark or gritty. I don't know.
Yeah.
It kind of left me feeling a little bit unsettled, but I did enjoy it. Maybe somewhere over here. You know, Gordon Gekko plays a corporate raider.
Yeah.
Lots of insider information, insider trading, that sort of thing, which certainly happens. I think it's a little bit dramatized, but there were some interesting stories like that from the 80s. So I'd probably put it somewhere around like hereish. I don't know.
Yeah. Somewhat realistic, but not maybe as fun as The Big Short or Wolf of Wall Street.
Yeah, I don't know. I mean, when you watch like an 80s movie, just like maybe not one of the most mainstream ones, but some of the other ones that are still popular, just not quite the same level of fame as other things as like Star Wars or whatever. They just seem to have this kind of, I don't know, presence to them that's almost a little unsettling.
Yeah. Yeah, I know what you mean. It's hard to describe, but I know what you mean.
Yeah. But anyways,
Well, makes so okay, so let's tie it back to the real world today. What's the relevance for each of those today? You want to go through maybe our six? So what did we do? We got margin call. That
yep.
was one of yours. You had margin call number one, and
Or,
then no, you had big short number one.
yeah,
We
yeah,
both
yeah. Gotta,
we
gotta
both
have
had
Big
big
Short.
short. Yeah, and that's a great movie. Margin call number two, I had number two was Too Big to Fail. And then we both had Wolf of Wall Street as number three, right?
Yep, yep.
All right. So for those, Big Short.
Yeah.
I mean, how realistic is it to today? What's the relevance today?
Well, I mean, I think it covers a lot of important aspects of the market. It's very focused on 2008 and exactly what was happening then. Are we going to have an exact replica of what happened in 2008 today? It's unlikely. All of these cycles, all these big events tend to have their own unique catalyst, cause, that sort of thing. But I think it provides a really meaningful insight into the market as a whole. One of the things that we talk about when we have interns and we're doing like a corporate bond ladder is about how we look at the Moody's and the S&P ratings for the bonds that we're buying. But in addition to that, we supplement it with Bloomberg data and we look into the issue itself and kind of provide our own assessment and make sure it lines up with what we'd expect. I think that ties into the Big Short. Some of those rating agencies, at the time at least, were colluding with the larger banks to prevent losses there. So I think that one's pretty relevant. I think there's a number of things that are relevant in there. What about you?
Yeah, I mean, I think that, the core lesson that, a market can be, confidently moving along and have some major issues underneath. That's not the last time it's going to happen. And who knows to what degree? But perfect example today is what's or recently, and I know some of this news coverage has died down recently, but the private credit issues. There are a lot of concern over what's actually in private credit, how risky are some of these investments, how many defaults are we actually having occur versus what's being posted or what's being talked about, and that's all the Big Short. There'll be another event like that to that degree. I don't know if it'll be the same, but something else that it's a good reminder that it's real easy to overlook things when you just have confidence that the system is working, but
Yeah.
it's not always working.
Yeah. Well, I love that quote that they open up with, and I can't remember exactly how it goes, but I think it's the Mark Twain quote that goes, something about the most dangerous thing isn't what you're worried about. It's the thing that you're certain of that's just not so, or something along those
Yes.
lines, which
Yeah.
speaks to the story of the movie very well. Um, while we're on that topic and tying it to modern day, I know a lot of the articles out there talking about Michael Burry right now being short on chips and kind of likening it to his large short position in mortgage-backed securities back in 2008. What do you make of that?
Yeah, I mean, it's also, very, you get Dalio can be this way as well. There's oftentimes people that are known to be, perpetual bears. And obviously that's not always true as well. Market cap weighted indices would beg to differ, right?
Mhm.
Um, but it's definitely they're going to be right at times, and obviously he's an incredible investor, so he may be right. And there's some concerns that I see there as well. So he may very well be right. There's also that saying you can be right, but just wrong on the timing, and create all kinds of it, and still be wrong.
Yeah.
So I don't know if he's going to be wrong. I guess time will tell. He was right in 2008. We'll see if he's right again. But it's certainly, that's the point of that movie, is that it's very easy to just be confidently moving along and moving along, and not be seeing some major issues until afterwards. And hindsight's always 2020.
Yeah, it certainly is. I mean, like you said, it's not like his concerns aren't unwarranted. I mean, the circular financing thing being a big issue that he's citing, just on the surface of it, it seems like, these are really impressive companies continuing to do well, and some of them even seem cheap right now. So who knows? We could be very wrong, and we could be heading into a similar issue. But at least right now, it seems like everything's on the right track.
Yeah, yeah,
What's
absolutely. So, all right. So what's number two? Margin call. What do you think? What's the relevance today?
I mean, again, tied to 2008, risk management is always a very important principle with any form of portfolio management, whether it's your own portfolio or a corporate portfolio, anything like that. Um, I think it's pretty relevant. It speaks to basically they found out that the assumptions in their model were wrong. And again, this one's kind of a fictionalized version of a true story, just playing out what happened at an investment bank when they found out that their book was carrying more risk than they expected, because they had flawed assumptions for the volatility of the underlying assets they were holding. In this case, it was mortgage-backed securities, I believe. So. Um, I think that's pretty relevant. Any model is only as good as its inputs, and 2008 is a great example of that. So, making sure that we're always updating our assumptions and testing those assumptions to make sure that we think they're in the right realm, I think is very relevant
Yeah,
today.
but you always want to plan for the worst and hope for the best. But yeah, a lot of times it's not fun to talk about those outsized negative potentials, but they have to be addressed and thought through, even if they're very unlikely that they're going to occur.
Yeah, for sure.
Well, and that's similar to like in Too Big to Fail. That was my number two. I think the different lens that Too Big to Fail looks through is, okay, now that this has, because margin call, that's really a parody on Lehman Brothers, right? Or
Yeah,
supposedly.
I think it's certainly got parallels to that. Yeah.
Yeah. So Lehman Brothers obviously collapsed, and then others were saved, right? Um, Merrill Lynch, Goldman Sachs, etc. So that question of who do you rescue and how quickly do you rescue them? Should they be rescued at all? Right? Um, I mean, that is still very relevant. Look at the banking issues we had in what was that? That was early 24, right? March of 24.
Hmm.
where we had Silicon Valley Bank and all those other issues where all of a sudden solvency of the banks is called into question.
Yeah.
I mean, what that precedent has now been set, right?
Yeah.
Whether that's good or bad is, I guess, I don't know if that's for us to judge here, but it becomes very tricky with how do you decide those things? Because the market should be, these firms should be, I guess, checked by the fact that they can go out of business. But if
Yeah.
they're not afraid to go out of business and they're so big that it's too big to fail, then a lot of those safety nets are not very valid anymore.
Yeah.
But
No,
that's the new regime we're in.
yeah, very valid point. I mean, even if they were to take on too much risk, something really fall apart, would the United States really let JP Morgan go under? Probably not. In 2008 sets the precedent that that's not going to happen. So
Yeah, exactly. Some will fail. I guess maybe that's
they'll let some fail. Yeah.
But the big ones, there are some that are just too big to fail, and that's really the new precedent we live in. So, yeah, that's very relevant today and the last 15 years.
Yeah. Well, I mean, it's funny to compare that to early 1900s when the government was looking to JP Morgan to basically bail them out. And then you go to 2008 and you have the opposite scenario going on. So,
Yeah.
anyways, interesting stuff. Yeah, I think that's definitely very relevant.
Yeah.
Wolf of Wall Street, how relevant do you feel like that one is?
This is an interesting one because I feel like relevance, I mean, that was the height of the pump and dump, penny stock, all that stuff, right? And I feel like a lot of that has dissipated, except in the meme coin
Yeah.
realm. People
Yeah.
buying up Dogecoin or promoters, people on social media promoting their new coin or their new whatever it is that some type of investment that's going to make you millions, right? It's playing on the same psychology, which is what Jordan Belfort got in trouble for, except it's kind of, there's some ambiguity on where the who regulates that and how do you regulate that, because it's not falling cleanly into that regulatory structure that we have in the past with stock markets. A lot of those meme coins are, they're not, it's not all of the meme coins. They're not traded on some centralized exchange. It's very different, but it's still the same mentality that's going on that Jordan Belfort and the Wolf of Wall Street movie kind of portrays as the easy to pump and dump and make lots of money for the people that are putting the scheme together. But somebody loses. Somebody has to lose in that game.
Yep. Yeah. I think that's a great parallel there. I mean, aside from that, I think, it is kind of made extreme. Everything in that movie is just so extreme, but
Yeah.
yeah, I think that's a great parallel to that. Maybe I know we went through those six pretty quick, and maybe the final spot where we wrap up before trivia, unless you have something else you want to go through, is maybe we could talk through how it impacts people's perception of the finance industry really quickly. Because I was thinking about it last night. I can't think of a single movie where the finance industry comes out looking good.
Yeah. It's true.
Like The Big
It's
Short.
true.
There's like certain players that end up looking good, but for the most part, like the finance industry comes out looking horrible. Like I can't think
True.
of one word.
It's true. I mean, they have, you're right. It comes out looking horribly to most, but it also makes it this enticing
Yeah.
place where you could potentially make a lot of money for some as well, and it draws
Yeah.
people to that New York, Chicago lifestyle where you're gonna, wear a vest to work and
maybe not a best. Maybe not a best.
Be best. I don't know. But yeah, there's a lot of if most who are not, if you're not seeking that out, the sensationalist lifestyle of people making a lot of money on Wall Street, there's a lot of negative connotations that come along with these movies about Wall Street, and that's what is that the Occupy Wall Street movement. I feel like a lot of that was driven by some of these movies sensationalizing what's going on there.
Yeah, and I mean, there's no doubt there's bad actors in just about everything, and you definitely need to be careful with your money. But none of these movies really help with that perception. And it is funny that you talk about, people being like, "Oh, I want to be Jordan Belfort." I remember I was in a business class and someone was like, "Oh, I want to be like Jordan Belfort." I think they said that like they raised their hand and they were like talking about something, and
Yeah,
everyone was, luckily for the most part, everyone was looking at them like, he wasn't like necessarily supposed to be like a hero character. He was kind of like a
yeah,
bad guy that you might kind of empathize with a little bit. But
yeah,
it's funny. I think that's actually like a relatively common reaction to watching a movie like that. They're like, "Oh, look at him. He's so cool. Like,
yeah,
look at that guy. He's partying it up, you know, taking big
yeah.
risks."
Making
I
lots
think,
of money. Yeah,
yeah, I think that's a somewhat common reaction that people have when they watch that movie. And I don't, that might be the opposite of the point that he was trying to make, but I've heard that in more than one place where people are like, "Oh man, he's so cool. Like I want to be like him." It's
yeah.
like, well,
Especially
I don't think that
younger.
that's really what you should take away from that movie, but
Yeah, agreed. Agreed. Especially younger folks like in college and whatnot. They're forgetting that he was doing something illegal and he went to, he was arrested for it.
yeah, and I mean, since then, the guy Jordan Belfort, the guy who it's based on, has been like, "Yeah, it was wrong. I shouldn't have done that." you know, but
Yeah.
a lot of people watching that movie maybe leave with the wrong takeaway.
Yeah. Yeah. Definitely.
Anyways, you want to wrap up with trivia?
Yeah, and actually I got a Wolf of Wall Street trivia question for you.
Oh boy,
I
I'm guessing it relates to the car.
no, actually, I
Okay.
thought about doing that, but yeah, you're gonna get this, I think. I figured the car would be too easy for you, so but I think you might get this as well. Do you remember the brokerage firm? It's a real brokerage firm that Jordan Belfort
Oh,
founded.
it's like
Do you know the
Stratton and
name?
Oakmont, right?
Yep, you got it. Stratton Oakmont.
Stratton Oakmont. Yeah.
Mhm.
I
Long
only know
Island
that
based.
because I was doing some reading, brushing up on these movies since it's been a couple of years since I um have watched most of them. All right, I've got one for you too that's related to a movie that we've both seen. This one's
Okay.
related to Dumb Money. At
Okay.
its peak in the January 2021 short squeeze, roughly what percentage of GameStop's public float had been sold short by hedge funds like Melvin Capital?
Oh, I haven't seen this in a while. I'm ended up having to guess on this. 30%?
140%, literally more than the float,
Really?
which is part of what made the squeeze so violent. Yeah.
Yeah. 140%. I didn't remember that stat from that. I'll have to
I
go
don't
back and
know that they
rewatch
list
that.
it, but just one of those things that I found when I was reading about it. I was like, wow,
Yeah.
that's an aggressive bet.
It certainly is 140%.
That's what I'm reading here, at least. Yeah.
Wow.
Pretty crazy
Awesome.
stuff.
Crazy stuff. Yep. Well, hopefully that was a little bit different episode this week. Hopefully it was interesting for some, and hopefully it had some real world connotations to 2026. If
Yeah.
not, at least the beginning part was. But I think that was I think it was interesting. It was fun to do that. And it's always a good reminder. I think, in my opinion, looking back at these movies and watching them from time to time, I obviously am entertained by them. They are really good reminder. It's a good reminder of some real world stuff that maybe is a historical, it's a historical case like The Big Short or too big to fail or something like that. But those things, they repeat themselves. And these are good, even though they're entertaining, meant for entertainment, they're good, real reminders of that these things happen. And they'll probably happen again. There'll be more finance Wall Street movies made in the next 20, 30 years. And it'll be about some other crazy stuff that happens that we never would have expected otherwise. So it's a good reminder.
It certainly is. Yeah. Well, I think that wraps it up for the week.
I think so too. Thanks, Nick. We'll be back next week.
Yeah. Thanks, everyone.
Bye, everybody.